Hi, everyone, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your host, Denny Troncoso, and this episode is number 4. I'm excited for this call as we have a commercial mortgage broker with us to discuss different options to buy multifamily properties. Now, if you want to buy multifamily properties, this is, of course, a great call. However, it is also good if you just want to be a capital investor or a passive investor, as you can have a better idea of the loan programs that your sponsor, the person that you're going to be investing money in, is going to be working with. By understanding financing, you have a better idea of understanding the deal and, of course, the most important thing, your return on investment. Now, if you don't already, please follow us on Instagram at Everything About Wealth. On Instagram, and if you want to follow our personal pages, my Instagram is at Denny Troncoso, or Desiree is at Desi, Dessi Troncoso. Now, Paul Winterode is a commercial mortgage broker with Bonneville Multifamily Capital. They focus on providing financing to multifamily properties, and they also have other loan programs as well for other commercial properties. He specializes in 3 areas, in particular HUD/FHA, Fannie Mae, and Freddie Mac. He also has some bridge capital options that we will discuss on a future call. Paul has helped me in the past to obtain financing on a property we were refinancing, and it was a pleasant experience working with him and his team. He is experienced, patient, and thorough. Now, without further ado, Paul, are you there?
I am. Thanks, Denny.
Hey, no problem. Thanks for being on the call today. And before we even get started, can you tell us a little bit about yourself and how did you get into the mortgage lending business?
Sure, my pleasure. It's great to be with you and share some of my thoughts and hopefully good knowledge. But I've been interested in real estate really all my life, but really dabbled in it for, I'd say, maybe the first decade of my career. I'm a golfer, as you know. We've chatted about this, and you always check in to see if I'm on the golf course when you call, and usually I'm in the office. But I played collegiately. I'm from Salt Lake City, Utah, so played for the University of Utah during my undergrad years, and still like to play golf. And a little nugget of a life goal I have on a personal note is I'm trying to play 500 different golf courses. I'm currently at 251. Got a few trips planned this year, so it's trying to knock those out. But I bounced around a little in my career and came to an inflection point where I was just like, hey, I'm passionate about real estate. I love finance. I feel very fortunate to have the opportunity to come on board with Bonneville, and I've been with Bonneville about 4 years now, completely immersed myself in multifamily finance, providing loans, and also got in the business of investing. Got about 128 doors that I'm a general partner on through a handful of different syndications. So it's been good. So I practice what I preach as well. So without going into too many details, that's a little bit of background.
That's awesome. I love your goals, both on with the golf courses and still being able to enjoy your passion, doing real estate as an investor, but also pursuing it as a career, and because of your background in finance and what you enjoy doing. And we definitely chat about that. Every time I call you, I do ask you if you're on the golf course, but sadly, you're always working, at least most of the time, right? Sadly.
Well, there's snow on the ground now in Utah, so that helps.
Yeah, that keeps you away from the golf course. Well, Paul, I know that there's a lot of lending options that are out in the marketplace for commercial real estate. And frankly, the reason for this call is to help those investors that are getting started and they are looking for some direction on what the options are and trying to put the pieces together of the puzzle on which option may be better for them, depending on the deal that they're working on, etc. So today, I'd like to discuss with you, number one, the HUD lending options that you have, then Fannie Mae and Freddie, and then maybe touch on a little bit of your bridge capital options or the portfolio options. And I know we don't have a lot of time, but let's see if we can get through as much as we can. So
Sure.
let's start with HUD. How about that?
Sounds good.
Can you tell us a little bit about how the program works and regarding amortization schedules, terms, and even just a little bit about a background of the program?
Sure. Let's jump in there. Let's do a caveat in that we may be starting with the most complicated and working our way back to the less complicated, but that's okay. There's a lot of interest in the HUD programs, and it's great that we've got the government working again to keep those balls rolling, if you will. But the HUD programs, you'll hear it referred to as HUD. Most people are familiar with FHA loans on the residential space, and technically these loans are FHA programs, but they're administered by HUD. And in the commercial space, they're commonly referred to as HUD loans. There's about a dozen different programs, but there's really two that we see that are used commonly. And those are the 221D4, which is the new construction loan. So a lot of developers have interest in this sort of loan because there's really some unique terms associated with it. And we could spend an hour talking about those. But it is a construction to perm loan, meaning it's one and done. You're not doing a construction loan and then building it and then doing a permanent takeout loan. It's one and done. It's a 42-year loan, so you have 2 years for the construction period, and then it rolls into the 40-year term and amortization. You just can't find that anywhere else, where you've got a 40-year fixed rate term and amortization. And you actually lock in that rate when you close for the construction loan. So the interest rate is the same during construction and into the permanent piece. So it's just a loan that eliminates a lot of risk for the developer, because they know exactly what they're getting into, and all they have to do is execute, and there's a long runway to exceed that without having to worry about the finance piece. The other common HUD program is what is called a 223F. This is for permanent loans. And so this is could be used for acquisition. That gets a little tricky because the loan closing process is much longer than your typical loan programs. To give you an idea there, it actually takes about a year to do the construction loan, and it's going to take about 5-6 months to do the permanent loan. And that's there's several reasons. The short answer is we are working with a government agency and great people, but it's just not as efficient as the private sector. So we won't wax too political there, but that's why that's the case. But the 223F is a permanent loan. It's a 35-year term and amortization fixed throughout, so there's no balloon payments or adjustments. So again, it's a very secure and safe loan. There's no refinance risk or really any chance of having a balloon payment coming due at a downturn or an unfavorable time in the market. And both those loans are non-recourse, which is a great way to insulate yourself from risk. It just means the property is the collateral, and there's not a personal guarantee for those loans.
So if the property doesn't perform, something happens with a downturn in the market, they're not going to pursue the borrower's net worth assets. They'll just keep the property.
Correct. The property would, in the event of default, the property would be foreclosed on, and that would be the collateral. There are what are called bad boy carve outs, and that's simply if fraud is committed or there's gross neglect. I mean, it's not that there isn't some responsibility there, but as long as the operator is doing their best and being honest about managing it, then that's the only risk in the event of foreclosure. There's the default rate on these loans is almost non-existent, though. Last year the numbers were something like 14 out of 11,000 loans, and I think it was about 10 of them were new construction. So it's pretty hard to fail. You got to really try.
Of course, yeah. You have to really try to mess it up.
Yeah.
So you mentioned the amortization and the term is both the same. So it's 35 years on the either purchase or the refinance. And right now, these loans, the rates are including. I know that there's additional step ups for insurances with the rates, but basically, what is the total rate included on average right now? And I know we're in January of 2019.
Sure. Yeah. So you bring up a good point. There is what is called the mortgage insurance premium. We'll use the acronym MIP, or the mortgage insurance premium. And so we're what is called a HUD MAP lender. So we put out our capital to fund the loans. It's not HUD or the government putting out the money. It's actually the lender, and HUD insures these loans. And so that mortgage insurance premium is how they keep the lights on and pay their staff. So that's the fees they collect. It's anywhere from 25 to 65 basis points, depending on the loan, if you qualify for green rewards, or if there's an affordable component of the housing, or whether it's new construction or permanent. We can get into those specifics, but that's the range. And so the rates on the 223F, the permanent financing, are in the low fours, probably about 4.25 right now, and the rates for the 221D4, the new construction loan, they're about 50 basis points higher. So you're looking at 4.75, 4.85 in that range, and then you'll have the MIP in addition to that. So the rates are very compelling, and even with the mortgage insurance premium, very competitive. Fannie Freddie rates, they'll vary depending on leverage and location, but right now we're right around 5, give or take, 30 basis points depending on location and structure.
Okay. So let's say about 5% currently, including the mortgage insurance premium. And the great thing, you mentioned that the loan stays fixed for a 35-year period. And because most commercial loans, they don't, right? So it's either my first loan was a 3-year loan, but they can go 5 years, 10-year loans, even 12 years.
Correct. Yeah. Most bank loans and candidly about half the multifamily market is funded by bank loans. It's rare to get beyond a 5-year term. You may have a 25-year amortization, in some cases 30. That's more rare in the banking space, but usually it's fixed for 5. So there's a reset, is what they call it, or a rate adjustment, or there may be a balloon. Fannie and Freddie, insurance companies, 5, 7, 10-year terms are common. All my buy and hold clients like the 10-year term because it gives them a long enough runway, and at that point there's usually equity buildup and recapitalization, pulling cash out, or maybe selling the property would make a lot of sense for them. But there are ways to extend that rate. With Fannie Mae, we can even go up to a 30-year term. There's a premium once you get past that 10-year mark. The rates, the longer they're fixed, they climb up, and it's fairly uncommon that someone would just want to set it and forget it. Now, although we do have requests from time to time, but there's certainly a velocity of the capital and reasons to recapitalize or sell, usually in a more compressed time horizon than 30 years.
Got it. And these loans, there are some net worth and liquidity requirements for the borrower, also called the sponsor. Could you talk a little bit about that, Paul?
Yeah. Let me speak in generalities. Every loan program is going to have a little different flavor on that. HUD actually has a little lower requirements. Insurance companies or banks may have higher, just depending. But the Fannie and Freddie credit standards are really straightforward, and it's a good benchmark to base things off of. So they require a credit score of above 680. We can do a little less than that, but that's essentially the price of admission. The pricing on the rate is not based on the credit score. It's just simply a show of responsibility. Not a problem for most people. And then the net worth, we like to see equal to the loan amount. So if you're looking for a $2 million loan, we like to see a net worth of $2 million. The net worth is going to include all your assets, less your liabilities. And that's also a combined number. So if there are 2 or 3 sponsors on the deal, one may have a net worth of $1 million, 2 others may have a $500,000, and that would qualify for that $2 million net worth equal to the loan amount. And some people do get confused, think, oh, it's the deal size or the purchase price. It is the loan amount.
It is.
The next qualification, yes, is liquidity or your cash on hand. And that's defined by cash in bank accounts, also, stocks, bonds outside of retirement account will qualify as liquid assets. And Fannie and Freddie like to see 9 months of principal and interest payments post-close. So after your equity contributions, they'd like to see some cash on the sidelines so they know it's not your last 2 nickels you're putting into the deal in case there's a rainy day. The money's not escrowed. It's just verified on a personal financial statement that you certify is accurate. And not everyone can do the math in their head. In fact, I can, as far as what 9 months in principal and interest payments are. So when I have done the math, a safe metric is 10% in cash. So if you have 10% of the loan amount in cash, again, that's combined from the sponsors, you're going to hit that hurdle, no problem. Just an aside, I believe, I don't want to attribute this wrongly, but I do believe I heard Warren Buffett say or read some quote at some point that you should always have 10% of your net worth in cash. That's something that I've tried to follow, and I always like to keep about 10% of my net worth in cash, and then you're usually going to be able to qualify for the loans. It's always good to have a little money on the sidelines as well. So it's just a good way to structure your finances and your assets, I think, whether you're doing multifamily loans or not.
Got it. So it's not good to put your last nickel you're telling to the new investors in the deal, right? Not a good idea.
Correct. Yeah. Not a good idea. You never know. You never know.
And I think you don't need to do that if you work with if you don't have capital, you work with capital partners or with partners that can use their partners, and then you can kind of build your cash that way. Uh, so a lot of
Definitely.
information on HUD and a lot of the requirements. You mentioned the net worth, the liquidity. Now, once we close a loan, there are some differences even after the fact that you have to put into your projections versus using a normal commercial loan or even a loan with Fannie or Freddie. And one thing that comes to mind is capital improvements. They're a little higher than Fannie or Freddie requirements, and there's also some requirements for distributions and the management company. Can you talk a little bit about that, Paul?
With respect to HUD, correct?
Yeah, correct.
Okay. Yeah, they refer to it as R for R, which is simply replacement reserves or reserves for replacements. You'll see RR as a line item. Fannie and Freddie, when we underwrite, it's pretty straightforward. It's $250 per door per year. So that's essentially a buffer to say, hey, there's some money that go to your capital expenditures. On HUD properties, because they're such long loans and there's no forced recapitalization event or forced, appraisal or sale, they want to make sure there's sufficient capital for the property to maintain its good standing, and so it's operational and functional and safe for the tenants. And so what happens is during the underwriting process, when you're getting the loan, an engineer will go to the property and do a property condition assessment, a PCA, or sometimes you'll see PCNA, which is property condition needs assessment. And the engineer will write up the report, and based on that and their projections and the life of the features of the property, like the roof and the siding, the windows, and all these things, they'll say, hey, we need this much. And so they sometimes require an initial deposit to that reserve account. So there is some money held in escrow. It is your money. So if those capital expenditures arise, you draw upon that and you take care of the work. Or if you sell the property, then the loan would be closed out and you'd get those funds back. There's also that monthly R for R, and that's really determined by that engineer through that report, and it can be anywhere from $300 to $500 that is simply escrowed into that capital expenditures account, and that's $300 to $500 per door or per unit per year. So, you do the math, you divide it by 12, and it's not a big number on a monthly basis. And again, it makes the deal foolproof in a way. That way, yes, you have to set it aside. It may impede your cash flow slightly, but here again, you're not going to need to have a capital call or come up with funds for the roof when it needs to be replaced down the road. It'll be there.
Got it. That's something that the governments learn from experience that, and this is a Warren Buffett quote, that managers think the tooth fairy is going to pay for capital improvements.
Yes, it's rose-colored glasses, right?
Yeah. So the government has experienced that capital improvements don't get done most of the time. So they've put these requirements into the loan to make sure that you have the right amount of money available for all future capital improvements. And I think $500 per unit per year covers that gamut pretty well. Wouldn't you agree?
Yeah, definitely. And it's simply responsible investing. It's just forced on you with the HUD program because it's such a long loan.
Exactly. Yeah, because I've seen owners out there where their properties are they just look terrible. They're falling apart, and I've talked to them, and they say, "Oh no, this is a great property that you should buy it. I've been able to do all these things with the property. I've been able to buy this. I've been able to buy a boat, and I've been able to buy this." And I'm like, "Yeah, you've been able to do that because you've been sucking the property dry. It doesn't. You haven't been putting anything back in." and
Yep.
that gets people in trouble. So with the HUD loan, one thing I've noticed with the HUD loan and even Fannie Mae and Freddie Mac, since we've been going back and forth on them, is that there's a certain loan amount, a minimum loan amount that you really need to focus on where these loans are going to be a better fit. And I think with Fannie and Freddie, it's $1 million or higher. Is that right?
Correct. So Fannie and Freddie have been around for a long time, obviously doing residential loans, and they've been doing multifamily loans for a long time. Freddie Mac identified an opportunity in what they call the small balance space. It's not to offend anyone. That's just most of their loans were for larger complexes, like $5 million loans and on up. There's a lot of smaller operators that were really their only option were the banks. And so they saw this opportunity about 4 or 5 years ago and have developed the Freddie Small Balance program. And it's designed to be more streamlined and a little easier process than the conventional Freddie program. And it's done really well. They've done a great job with it. It's become very popular, and it is technically $1 to $7.5 million loan amounts. Fannie Mae has been on the sideline, and they've sort of woke up, but they haven't put as much effort and energy in that. But they also have a small balance program. Typically, it's most competitive in more rural markets or smaller markets, and so I would say 75-80% of the time, Freddie is the better option there, but we look at both for our clients and determine what's best. So yeah, if you get over that $1 million loan amount and on an acquisition, you want to plan on 75 to 80% leverage. So if you're buying a property that's $1.5 million and above, then or has that value, then you can be in that game. HUD doesn't have that minimum threshold. If you read the guide, the MAP guide, it says as long as it's 5 units and above, then it qualifies. So technically, it could be a $600,000-$700,000 property as long as it has 5 units, or technically the commercial when it becomes commercial multifamily.
Mm-hmm.
But from a practical standpoint, it just simply doesn't make sense. I mentioned earlier briefly the underwriting process on a 223F on the permanent loan. It can take 5 to 6 months. Well, it's not like we're just twiddling our thumbs. The government does require a fair amount of underwriting and third-party reports, and more so than really any other loan program out there. Well, those reports cost money. Mm-hmm. And so, and HUD has their initial examination fees and that sort of thing. So it's fee heavy. The HUD loan is fee heavy. Now, every time I run an IRR analysis on HUD versus Fannie or Freddie or other loans, your returns as an investor are higher because of the rate and the term and the fixed nature of it. But you're paying a little more going in. So you're going to pay more in fees and third-party reports and legal fees for a HUD loan than really any other loan. And it's simply the price of admission. And so there becomes some economies of scale. Mm-hmm. And there's no hard and fast rule. It depends what the investor is looking for. But I would say that a good benchmark is the $4 or $5 million loan amount, that it starts making sense where those fees are absorbed over the size and the scale of the property. It just becomes really fee heavy if you're trying to do a $2 million loan. People do it, but it's more rare. You have to be really dead set and on HUD being the best way for you and willing to pay that price. So
Mm-hmm.
I don't want to discourage anyone, but I try to be candid in my business and inform people of of the different situations and pros and cons of different loans.
Yeah, and I was thinking the loan amount, the threshold would have been lower, maybe in the $2 to $3 million space, and you said in the $5 to $6 million. However, what I have seen is that if you're going to be holding the property for a long time, because of the long term, the security of that, where you can you don't have to worry about refinancing, et cetera, then if you put it in the long term, then it may work out for you.
Oh, absolutely. When you're looking at your overall return, even at those lower amounts, I would say, like 2 million minimum, but beyond that, it certainly will pencil, especially on a long-term hold. But generally speaking, that's where it is.
Got it. With the talking about HUD and then kind of just closing up on this, but one of the benefits of it that I've seen is when the property has a lot of renovations that need to be done, and you're looking for something that you can roll all of those costs into the loan. This is one of the best programs that I've seen, aside of getting hard money / bridge capital. As long as the construction costs are less than $15,000 per unit. Can you talk a little bit about that, Paul?
Correct. Yeah, it really is a great component of the 223F, the permanent loan. They'll include in the loan up to $15,000 per door, and so you are combining any exterior work and interior work in that budget. So you just take the number of doors and times it by 15,000, and that would be the threshold of what you could include in the loan. But that goes to those repairs. And when we do that, we can also underwrite on a pro forma basis. So of course, we're always looking at the actuals, how a property is currently performing. But when we know that, hey, these funds are going to be allocated for these improvements and there will be subsequent increases in income in the property, then we can underwrite to those projections for the loan. And so what that really translates into we'll call it a light rehab scenario is a very small amount of money out of pocket comparatively, and you're under 5% on that interest rate. And so it becomes a one-stop shop. You're not doing a bridge or construction loan and then transitioning into the permanent loan down the road. So it's really pretty slick. Again, there's some hoops to jump through to get there. You definitely need a situation or a scenario where you have some runway, and the most common way to create that runway is if you're buying a property, it would be, if there needs to be a quick close from the seller's perspective, a short-term seller financing scenario would be ideal. Maybe you put 10-15% down with them and say, hey, we're working on this loan. You start the process even before you close, but you just buy yourself a few months to get that all the paperwork and underwriting done so you can close the HUD loan. And simple way to bridge that gap if a short close is required would be seller financing.
Good advice. And because this has been just a wealth of information, but because it's, I wanted to keep the call to around 30 minutes. We're going to leave the bridge capital and or the portfolio lending for a different call. We'll call that a part 2 with Paul. But in closing, Paul, for a new investor, someone that's getting going with multifamily, and they definitely need to build a team. And one of those people that they want to add to the team is a mortgage broker, someone like you. Can you give them some advice on, number one, on how they can work with a mortgage broker once they find someone, deal by deal, but then also how to find the right person for their fit, for their team?
Sure. Real estate, especially commercial real estate, in which multifamily would fall, is a team sport. There are a lot of people involved. As a sponsor or an operator, you're really a CEO of a small business. You've got to coordinate with your property manager and any contractors. If you're handling any construction, there's a number of elements to the property management, both inside and out of a property. And then you've got attorneys for legal work, lender, obviously. There's a number of different people that you need to engage with. And so a mortgage broker, obviously I'm biased. That's what I do. But I believe is a critical team member, because a mortgage broker's job is to develop and maintain relationships with a myriad of different funding sources and capital. Every week I'm looking to expand my network and database. I say I've got hundreds of different capital sources, and I do. And so my job is to not only know who has an appetite for multifamily loans, but what that appetite is, what type of loans they do, what sort of leverage. And as I expand that and understand their underwriting, I can quickly provide shortcuts to my clients to which options are the best for them. And mortgage brokers charge an origination fee. We're typically 1% of the loan amount, and on some occasions, depending on the loan, lenders may have an additional origination fee. That's typically only on your bridge or construction type programs that you'll see that. But my job is to go out, create a little mini market. So you come to me with a deal, and I'm going to say, okay, I know that there's a handful of lenders that would be interested in this. And so I'm going to go to them and say, hey, I'm going to package the deal. I'm going to get to the right person. I'm going to present it. I'm going to sell it to them. And then I'm going to get them competing for it. I'm not going to share where people come in on their bids, but I'll say, hey, if you want this, go low. And so it creates the right market with the right players and produces the best terms, and really simplifies the process for the borrower or the sponsor, because they're not out shopping it. They're not providing financials to 12 different places and trying to coordinate that. It gives them time and energy to focus on other aspects of the deal. They're certainly going to be involved, and there's documentation requests, but that's how people can save time and really money, I would argue, because human nature would be to call up a couple banks that you're familiar with because you see them on their advertising on the stadium wall or their brick and mortar, and banks are really good at saying, here's what we got, take it or leave it. And there's only so much energy to find the best terms. And that's really what my business is.
Awesome. And I'd say, with adding to what you just said with saving money, is if you take that offer with the bank, it may cost you $1,000 to $5,000 a month in cash flow because you took their shorter amortization schedule, or even a capital that you could have used if you're doing a cash out refinance, capital that you could have been using to buy another deal, which could add another $3,000-$5,000 a month, with using these Fannie Mae, Freddie Mac, and HUD agency programs to it.
Yeah, definitely. And that's there's not a retail space for that. Really, the pathway to those programs is through a mortgage broker or a very large national firm. That there may be some direct play, but there's not like there's a brick and mortar type scenario. It's hard to find those folks. So the only other thing I would add is, you want to talk to a couple and see what their style is, and if you like working with them. There's a lot of back and forth, and I've had a lot of great friendships come from people I've worked with on loans, simply because you spend a lot of time together. And Denny, I'd include you in that group of becoming friends with the people I work for that are my clients. And so you want to have an amicable relationship, because there's a fair amount of back and forth, and having someone that'll answer your call, I think is valuable as well.
Yeah, I appreciate that, Paul. And I look at you the same way, because you're out there in the trenches. We're working on the deal. We want to make it happen. And then we're talking every day pretty much while this process is going, and even several times a day. So I think the fit of the personality needs to be there. And I've talked to other mortgage brokers, and something that I've experienced with Paul, that I have experienced with others, is that a lot of people are out there looking for these big deals, and they're too busy to work with the small guy. But frankly, everyone, unless they're coming from a wealthy family, they start small. So everybody's building, and I think Paul has, from the beginning, has given me a certain amount of service. No matter, I could have been a $10 million or $100 million client, but actually I was just starting out with $1 million loan. So, and I appreciate that, and I highly recommend Paul for that when you're out there looking for a mortgage broker. And with that, transition to, how do people get in touch with you, Paul, if they're looking for someone to work with?
Email is probably the best way to catch me. I'll give you my email address. It's just my first name, Paul, Paul, at bmfcap.com. And those are essentially the initials of Bonneville Multifamily Capital. So bmfcap.com is how to reach me. And I'll also give my phone number, which is 801-323-1050, 801-323-1050.
And is Bonneville have a website that you like to share?
Yeah, it's the bmfcap.com. So bmfcap.com is our website.
Excellent. Well, Paul, I can't thank you enough for being on the call today. I think people are going to get a lot out of the information that you shared, and hopefully it helps them do not only one, but several loans with using the Fannie Mae, Freddie Mac, and HUD programs.
That'd be great. We're here to help, and it's been a pleasure as well. Thanks for the invitation, and I'll look forward to part 2 when that time comes.
All right. Take care. Well, thanks for tuning in. Hopefully, Paul was able to share that there are so many great options to obtain financing for multifamily properties. If you are a capital partner, want to be a passive investor, make sure your sponsor, the person that you're investing money with, is using the best financing options available. This is just going to increase your return on investment. To learn more about how to be a private investor, visit our website at everythingaboutwealth.com. And if you like the show, make sure to subscribe and like us on iTunes or your favorite apps. This definitely helps the show to get out there to more people to see the show. Now with that, see you on the next show. Take care. Bye-bye.